What's good, everybody? My name is Chase Lawson. This is the Financial Freedom Show, where I make personal finance simple. Thanks so much for tuning in. So if you're looking to start investing and you don't know where to begin, or if you've been investing and you want to maximize your returns, this video is for you. Today I will discuss the top rules when it comes to investing. In fact, this is so simple, these rules can fit on an index card. So for more great content like this, make sure you subscribe, hit the notification bell below so that you know when each new video comes out. So let's get started. So first and foremost, these rules assume that you have money to invest. If you're currently spending more than you bring in each month, you first need to get that under control because otherwise it doesn't really make sense to invest. But assuming you do have excess money coming in, these rules will get you where you need to be. So rule number 1, invest in your employer's 401k to get the full match. So if you have a job currently in America, most likely you're offered an opportunity to invest in a 401k. Most employers in America today offer some sort of retirement program, be it a 401k, 403b, or a pension plan. In fact, more and more employers are offering this each year. So if you work for a company, chances are they offer a 401k. Now, of those employers who offer a 401k, most of them offer a match of some sorts. So once again, most employers offer a 401k and then most of them offer a match. However, upwards of 2/3 of Americans don't even contribute or participate in their 401k. So there's a big disconnect there. This is an issue that I see every day with some of the people I work with and talk with, is that their company offers a 401k, but they're not even investing in it. And this may be due to lack of knowledge or some other factor, but if your employer offers you a 401k, especially if they offer a match with it, this is a no-brainer. Start here before you invest anywhere else. Because when you contribute to a 401k, you can easily get an extra 3 to 6% or more in additional income per year, no questions asked, just for investing for your retirement. Now, there's a few benefits to a 401k. First and foremost, it is a retirement account. So a lot of people, as they get near retirement, they worry if they're going to have enough money to last them through retirement. Are they going to have to work longer? Will their money survive their lifetime? And so with a 401k being a retirement account, if you start today, you slowly build up that account over your whole working career, and you won't notice a slightly lower paycheck, but what you will notice is the hundreds of thousands of dollars, if not millions of dollars, that you have when you hit retirement due to having that 401k. And you'll be able to live off of that throughout retirement. The second benefit of a 401k is there are tax benefits to it, to either defer or even just minimize the tax liability that you pay. So another great way to do that. In addition, the biggest benefit that I mentioned is that a lot of employers offer a match of some sort. So a lot of employers will offer between a 50 and 100% match on the first 6% that you contribute to your 401k. That's a common 401k plan. So for example, just to make the math easy, let's assume that you make $100,000 a year and your employer offers you a 50% match on the first 6% you contribute to your 401k. So in this example, you make $100,000, you contribute $6,000 of that to your 401k, and then your employer will take $3,000 of company money and invest it in your 401k on your behalf. So you invested $6,000 that year, but now your account's worth $9,000 before any growth in the value of your investment. So you instantly get a 50% return on your investment just like that. All you have to do is just set up the account, define the amount that you want contributed to it, and then pick the type of investment you want it to go into. And then you'll see every paycheck, money will come out, and then your employer will match that. So I don't know of any other investment vehicle like that that'll provide an instant 50 to 100% return on your investment just like that. So this is a no-brainer. Before you invest anywhere else, make sure you have your 401k taken care of, at least enough invested into that to get the full match. Great. So rule number 2, don't try to time the market. So nobody knows what's going to happen in the market, right? It goes up and down each day, week, month, year. None of us control that, right? There's a lot of factors that go into that, and it's pretty impossible to predict that. I'm sure none of us could have predicted what would have happened with coronavirus and how it ended the longest bull market we've had, in some time. So, we're in a bear market now, but this will happen every few years. We'll experience a bear market. So you cannot try to time the market. The issue with timing the market is it requires you to be right twice. Once when you buy the investments and then again when you sell the investments. And since it's pretty hard to predict the market, it's going to be near impossible to get it right twice, right? Me and you will never be able to know what's going to happen in the market. But what about those who this is their daily job? They're in this each and every day, investing on behalf of their clients and more, right? So let's look at mutual fund managers. As I talked about in a previous video, mutual funds have active fund managers that essentially will buy and sell securities on your behalf, with the goal being to outperform the market. Oftentimes they charge between a 1 and 2% expense ratio, which is pretty high, but they justified that high expense ratio because their goal is to outperform the market. And so they claim that if they can beat the market, it's worth it to pay a little bit more in fees. So how do these active fund managers actually perform? Are they better at outperforming the market than you or I? If you look at the actual statistics, you may be surprised to find out that they are not any better than we might be at investing in the market. In fact, if you look at any given year, mutual fund managers underperform the market at least 75% of the time. So if you take any 4 mutual fund managers, only one of them may be right that year and outperforming the market. And if you look at it over a longer term period, the longer term horizon that you look at, the more likely they are to be wrong and underperform the market. In fact, if you look at a 15-year performance for mutual fund managers, that statistic of outperformance drops to below 5%. So they charge a premium for what they do, and even they cannot beat the market. So that should tell you that it's pretty damn near impossible to beat the market. So what caused these fund managers to underperform the market? Well, there have been studies into this exact thing, and the number one reason for their underperformance was due to the turnover rate, or how frequently they bought and sold these securities. So on average, these fund managers will buy and sell a security every 3.46 years, which is a pretty short time horizon. Definitely not long enough to realize the full benefits that investing can have when you have a long-term investment perspective and mindset. There's a saying that time in the market beats timing the market, and that is 100% true. It doesn't matter what happens day to day with the market. Have that long-term perspective in the market, because what you don't want to have happen is you don't want emotions to come into play and keep you from investing and keep your money on the sidelines. There were experts, quote unquote, in finance that have been saying ever since 2017 that we're going to be entering a bear market soon. And we didn't experience that until 3 years later in 2020. So had you listened to these experts, you would have missed out on a pretty great year last year alone. Last year in 2019, the S&P 500 returned close to 29%. So you would have missed out on a 29% price appreciation in your money by keeping it on the sidelines. So don't try to time the market. Just keep investing gradually over time, and you will win with a long-term perspective, right? So going off of that, rule number 2, we get to rule number 3, start early and stay long. So the best time to invest was yesterday. The second best time to invest is today. So like I mentioned, you may be 15, you may be 25, you may be 55. It's never too late to start investing. In fact, you should start investing today and invest for a long-term perspective. If you look at the S&P 500 and its performance over the past century, you would see that the S&P 500 historically has returned between 7 to 10% per year, adjusted for inflation. Now, yes, there will be years where the markets will go down and there will be negative returns, but over a long-term period, the compound annual growth rate in the markets is between 7 and 10%. So rest assured that, yes, you may see your investments go down periodically, but over a long-term perspective, you will win time and time again. In fact, if you were to invest $1,000 today, never make another investment again, and let it sit for 30 years, earning 7% annual return, and 30 years from now, that $1,000 will be worth $7,612.26. So one $1,000 one-time investment, letting it ride for 30 years in the market, returning 7% per year, will provide you with $6,612.26 return on that investment, adjusted for inflation. So it's a win-win. You're going to see even more return on your money if you continue to invest a little bit each month or each year. So that's just an example of a single investment. So just imagine if you invest a little bit over time, what that's going to do to your money. Rule number 4, invest what you're comfortable losing. So this rule serves a few purposes. So anytime that I invest an amount that I would be okay in the absolute worst case scenario if I lost it all. And so by implementing an approach like this, it does a few things. One, you make sure you have all your bases covered first. You make sure that if you have any upcoming expenses over the next few months to a year, you have that money set aside to pay for them. You have an emergency fund of 3 to 6 months of living expenses in the event you were to lose your job, have a major health scare, or some other emergency were to arise. So you make sure you have those bases covered before you invest anything, because you don't want to get into a situation where you have to pull that money out to cover those expenses. So make sure you have those covered first, and then you can start investing. In addition, the market can be very volatile. So by having that mindset that you're okay in the event you lose everything, it allows you to take your emotions out of it. You're not going to get in that experience where you're panic selling when the markets do start underperforming and experiencing a negative return, right? You're going to leave it in there for a long-term perspective because you're okay in the event that you lose it all. You had that mindset going in. In addition, going back to the long-term perspective, if you have your investments in the markets for over a year, you pay less in taxes on the growth. So there's benefits to keeping it in for a long time as well. In addition, by having the mindset that you're okay losing everything, it keeps you from investing more at one point than you're okay doing. Rather than investing $10,000 at one time, maybe you invest $833 per month throughout the year. It still gives you the $10,000 invested over the year, but it spreads out those investments, and each investment's only $833. If you lost that $833, you'd probably be okay. Whereas if you lost $10,000, it might not be okay. And then finally, the great benefit of this is it helps you invest in safer assets and investments, right? Rather than putting all your eggs in one basket in one company's stock, where if they go bankrupt, you're out everything. You spread your dollars in safer investments and across more companies, right? So that goes hand in hand with rule number 5, which is diversify. So I'm sure if you've heard anybody talk about investing, they talk about how great it is to be diversified. And this is 100% true. There's a number of ways you can be diversified with your money. There's 6 main ways, and then within each of those 6 ways, there's more ways you can diversify. So first and foremost is U.S. stocks. So obviously a lot of us are going to have our investments in a lot of different U.S. companies, right? But within that, make sure you have them spread across a mix of large, mid, and small cap companies, which are large cap are obviously the massive giants. Mid cap or medium-sized companies, and small cap are the smaller companies. Have your money spread out throughout all 3 of those business sizes. If you look at the Dow Jones Industrial Average or the S&P 500, they are only tracking large cap companies, the largest of the largest companies. And that could be great, but if large companies start underperforming, you want to have your money spread across mid and small cap companies as well. In addition, have your money spread across multiple different industries, technology, energy, real estate, consumer goods, and more. And finally, have your money mixed between both growth and value stocks. Growth stocks are companies that are expected to continue to have their price grow over time. Value stocks are ones that return a dividend. Next, we have foreign stocks. So yes, a large portion of your investments can and probably should be in U.S. stocks, but you should also have some money invested in foreign stocks. And this can be spread between both developed nations and emerging markets. Emerging markets offer a chance for a greater return, but they are riskier. But having investments in foreign stocks, make sure you're diversified and not just being in U.S. stocks. So there's stocks, obviously, but then another type of investment you should be diversified in is fixed income. So first and foremost, U.S. fixed income. So this includes things like U.S. Treasury and savings bonds, municipal bonds for local cities and localities, corporate bonds, bonds issued by companies. So the great thing about fixed income investments like these is that they pay, as the name implies, they pay a fixed income amount to you. So they're, theoretically safer than stocks, but don't offer as large of a return potential because it is, a fixed amount, right? In addition to U.S. fixed income, also have a portion of your investments in foreign fixed income. This provides you protection from a dollar decline, right? If the dollar starts underperforming compared to other countries' currencies, you have some money in foreign fixed income securities as well. The fifth way is through commodities. This is like gold, oil, wheat, real estate, and more. And then last but not least, cash. Always make sure, as I mentioned before, that you have some money set aside in cash. In an absolute worst case scenario, right? You want to make sure that you're covered, and you're not going to have to pull money out from other places. Now, you don't have to be diversified in all of these areas. Obviously, the more diversified you are, the better. But if you're just getting started out, don't have a lot of money, just find a way to be a little bit diversified across some of these areas, right? That could be through index funds or other avenues as well. So rule number 6, move investments from stocks to bonds as you near retirement. So as you age and as you get closer to retirement, you need that money to be safer and more accessible, right? So stocks can be very volatile. You can see major swings in the market in a single day, week, month, year. So when you start to get closer to retirement, you're going to need more certainty with that money because you need to be able to predict, will I be able to live off this money until I die? If you don't have any other money coming in, right, you need that certainty. So, for example, if we experience another situation like coronavirus and you're nearing retirement and you're only investing in stocks, you may see a 25-30% drop in your investment value, and then you may have to work longer or, find some way to live off that money that's now kind of depleted. So as you near retirement, you need to move from riskier assets like stocks to safer assets like bonds that pay a more known amount and are less volatile. There's 2 ways to do this. One is a pretty easy formula to follow. It's the age rule. So if you take your age and convert that to a percentage, you should have about that much invested in bonds. So if you're 25 years old, about 25% of your investment should be in bonds. If you're 45, 45% in bonds, 65, 65%, and so on. That's an easy rule to follow, and make sure that you move assets from stocks to bonds as you age, right? Another way to do this and make it more automated is through a target retirement fund. So I talked about in a previous video how I'm a big fan of Vanguard's target retirement funds. They have a low expense ratio of about 0.15%. The great thing about a target retirement fund is that they will do that work for you. They're invested between both U.S. and foreign stocks and bonds. And as you age and get closer to that target retirement year, they'll move investments from stocks into bonds and do that work for you. So something good to check out, and probably have at least some of your money invested in a target retirement fund. They've offered great return potential, and then do that heavy lifting for you. And then finally, rule number 7, buy what you know or can explain to others. This is also known as, if your plumber tells you to invest in it, don't invest in it. Nothing against plumbers. They make a lot of money and they're great at what they do, but they're not in the field of personal finance. And it's not just plumbers, if your neighbor, best friend, person down the street are telling you to invest in it. If everybody's saying invest in something, there's probably a red flag to be raised there, right? Unless they're in the personal finance world, they do this each and every day. And even then, maybe put some question marks up there. And this is a big rule, right? A lot of people like to buy into the hype, and that can make you lose a lot of money, right? Especially if it's a risky asset. A big example of this was with Bitcoin and other cryptocurrencies. So Bitcoin became very popular back in 2017. It got up to $20,000 in late 2017, and now it's less than half of that, below $10,000. So it rose pretty quickly, and then it tanked pretty quickly as well. I personally don't know much about cryptocurrency or Bitcoin, or I don't understand it. I don't care to understand it. If you're passionate about Bitcoin and other cryptocurrencies, more power to you. If you think it's a good investment, by all means, invest in it. I don't know it. I can't explain it to others, so I'm not going to put my money in there, right? This is a perfect example of everybody was hyping it up, and now look at it, right? It may recover, but who's to say, right? Invest in things that you know about, are passionate about, or can explain to others, right? So great. Those were the 7 simple rules to investing. You don't need to spend a lot of time trying to figure out the perfect stock to buy or when to buy it, right? Just follow those 7 rules and you'll be in a great place. There's nothing hard or complicated about it. You're going to make a lot of money investing in the market if you follow these rules. I really hope you enjoyed this video. Let me know in the comments below what rules you're looking forward to implementing in your life. And of course, make sure you subscribe and hit that notification bell below so you'll be notified when new content comes out. And if you did like this, please give me a thumbs up to let me know you got value out of it, and I can continue producing great content like this. Thanks, guys, and go get them.